Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets buried in corporate filings. And today we're digging into Australian Oilseeds Holdings Limited. This document feels like a company trying to get its ducks in a row for the big leagues, maybe even attract some new investors. They filed this as a pre-effective amendment to a registration statement. Think of it like a company showing the securities regulators, the SEC, a revised version of their plan to sell shares to the public. They're not selling anything right now in this document, but they're preparing the paperwork. This is a deep dive into a company that has been through some significant changes, like a business combination, and they're letting us peek under the hood. Let's see what is really going on with Australian Oilseeds Holdings Limited. If you appreciate getting straight insights from corporate documents and want to understand what these filings mean for the companies behind them, make sure you subscribe. And hey, if you are into this kind of deep dive, we have a Discord community linked in the description below where we discuss these filings and more. So, what is Australian Oilseeds Holdings Limited all about? At its core, it is a company focused on making and selling edible oils and products from oilseeds. The really interesting part is their angle chemical-free, non-GMO and sustainable. They believe this approach is the key to solving many health problems, and they're aiming to be a major player in this space, especially in the Asia-Pacific region. They say they've grown to be the largest cold pressing oil plant in Australia over the last 20 years. Cold pressing is a method of extracting oils without using chemicals, which they highlight as a healthier and more natural process. Now, a big event they mention is a business combination that happened on the 21st of March 2024. This sounds like a bit of a corporate maneuver. Essentially, it looks like they merged with a company called Accession Corp, which was probably a special purpose acquisition company, or a SPAC. SPACs are often created to help private companies go public. So, this business combination is how Australian Oilseeds Holdings Limited became a publicly traded company on NASDAQ. It involved a merger and a share exchange. This is a pretty common way for companies to get listed on the stock market without going through the whole traditional IPO process. They also point out they're an emerging growth company and a smaller reporting company. This is important because it means they get to follow some simpler rules for reporting their financial information compared to bigger, more established public companies. For example, they only have to show 2 years of financial statements instead of 3. This can make their filings shorter and maybe a little less detailed. But it is a way for newer public companies to ease into the reporting requirements. Another thing they highlight is that they are a controlled company. This means one shareholder, JSK's Enterprises, our majority shareholder, owns more than 50% of the voting power. Because of this, they can take advantage of some exemptions from certain corporate governance rules that NASDAQ normally requires. This includes not needing a board of directors to be made up entirely of independent people. While this might make things more efficient for the company, it is something investors should pay attention to, as it means shareholders might not have the same level of oversight or protection as they would in a company that follows all the standard NASDAQ rules. Now let's talk about the risks. Companies have to lay these out very clearly. For Australian Oilseeds, a big one is stock price volatility. They mention their stock has seen wide fluctuations in price and trading volume. They've even had issues with NASDAQ listing requirements, like their stock price dropping below $1 at one point, though they did manage to regain compliance. They also talk about the risk of delisting from NASDAQ, which would make it harder to buy and sell their shares and could hurt their ability to raise money. Another risk is related to their principal shareholders having significant influence. Since one entity owns over 50%, they can really steer the company's direction, including electing directors and approving big corporate actions. This concentrated power means that individual investors might have less say in how the company is run. They also mention the risk of securities class action lawsuits, which can happen to companies after a stock price drop. Diving into the business itself, they are heavily reliant on selling their products. If they can't sell enough or if their profit margins shrink, it is a problem. They lack product and business diversification, meaning their success is tied closely to the agricultural industry. Any downturn in farming could hit them hard. They also depend on contracts with farmers for their oilseeds, and losing those contracts could seriously impact their business. Plus, they noted a material concentration of revenue from a small group of customers, which means losing even one big customer could be quite damaging. Regulatory changes are another big concern. Think about rules for trade, food safety, sustainability, and environmental laws. Any shifts in these regulations could negatively affect their operations and finances. They also point out their results can fluctuate due to things like lower sales, unfavorable weather, and rising oilseed costs. Water and power supply disruptions are also a risk, as is competition. And they admit their management has limited experience in running a public company, which can add to the complexities. They've also had net losses in the past, and there is no guarantee they'll become profitable soon, especially as they invest in expanding facilities. Then there are the warrants. These are like options to buy company stock at a certain price. The company can actually redeem these warrants, basically buying them back from holders at a very low price under certain conditions. This could force warrant holders to exercise their warrants at a bad time or lose out on potential gains. It is important to note that the company isn't selling any shares in this filing. The shares being offered are by selling shareholders, meaning existing owners are selling their stock. The company won't get any money from these sales. Don't expect to receive dividends anytime soon. They say they don't anticipate paying cash dividends in the near future and intend to keep any earnings to reinvest in the business. So investors are really relying on the stock price going up for their return. Now, let's get into the numbers. This section is where the company talks about what happened financially and why. For the year ending the 30th of June 2025, their sales revenue jumped up by about 23.6% compared to the previous year, bringing in roughly 41.7 million Australian dollars. That sounds good on the surface. Digging into where that money is coming from, wholesale oils actually saw a decrease of about 7.7%. However, retail oils had a massive increase of over 58%, which they attribute to big supermarket chains like Costco, Woolworths, and Coles. This shows a shift from selling in bulk to selling directly to consumers, which can sometimes mean better margins. High protein meals also saw a healthy increase of 18.4%. But here is a look at the costs. Their cost of sales went up significantly by 37.5% to about 38.2 million Australian dollars. The main reason given is an increase in the cost of inputs like raw materials and labour, without a corresponding rise in sales prices. This is a classic sign of pressure on profit margins. This led to a drop in gross profit by about 41.5%, even though sales went up. That is a red flag. It means their cost of producing goods is rising faster than they can sell them or charge for them. Their operating profit loss also swung from a profit of nearly 3 million Australian dollars in 2024 to a tiny operating loss. Finance expenses more than doubled, going up 74.2%. This is due to them using more debt, like trade facilities and loans, to fund their operations and expansion. All of this resulted in a significant loss for the year of about 1.46 million Australian dollars for 2025. A big improvement from a massive loss of over 21 million Australian dollars in 2024. But still a loss. Let's look at where they stand financially. On the asset side, they have about 15.2 million Australian dollars in current assets, which are things they can quickly turn into cash. Their plant and equipment and other long-term assets total around 19.1 million Australian dollars. So total assets are around 34.3 million Australian dollars. On the flip side, their liabilities are much higher. They have about 28.2 million Australian dollars in current liabilities, meaning debts due within a year. This includes a significant amount of trade and other payables and related party loans. They also have non-current liabilities of about 1.4 million Australian dollars. Total liabilities are nearly 30 million Australian dollars. This leaves them with net assets of about 4.65 million Australian dollars. While they have positive net assets, a significant portion of their current liabilities are debts that are due soon. When you look at equity, which is basically what is left after liabilities, it is about 4.65 million Australian dollars. This is a vast improvement from a negative equity position in 2024, largely due to the debt and convertible notes being converted into shares. This is a complex financial dance, but the improvement in equity is a positive sign after the prior year's struggles. They're tracking current member liabilities, which represent debts due within a year. For 2025, this is about 28.2 million Australian dollars. This is a critical number to watch, especially since their current assets are around 15.2 million. This gap highlights a potential short-term cash strain. Looking at their structure, they have a few subsidiaries, mostly in Australia. Australian Oilseeds Investments Pty Limited is their main investment arm, and Cootamundra Oilseeds Pty Limited is where the actual oilseed crushing happens. It is interesting to see Edoc Acquisition Limited listed as a subsidiary since it was the SPAC they combined with. This is a really important section. They explicitly state there is substantial doubt about the company's ability to continue as a going concern. This means the auditors believe there is a significant risk the company might not be able to pay its debts and continue operating for at least the next year. They've had losses, a working capital deficiency, and rely heavily on funding from banks and related parties. They are pinning their hopes on drawing down more debt and loans, and potentially securing a large equity line of credit. If these don't pan out, they could be forced to sell assets at a loss. This is a major red flag for investors. They have concentration of key customers. In 2025, about 62.4% of their total sales came from their top 5 customers. For 2024, it was even higher at 65%. Having so much revenue tied to just a few clients makes them very vulnerable if even one of them decides to stop buying from them. It is like a baker who relies on only one big restaurant for all their business. If that restaurant closes, the baker is in big trouble. Looking at who is running the show and what they're paid. For 2025, Gary Seaton, the co-chief executive officer and chairman, received about 223,000 Australian dollars, mostly in salary. Amarjeet Singh, the chief financial officer, made about 81,000 Australian dollars. Bob Wu, the former CFO, received around 121,000 Australian dollars before he left. It is worth noting that in a company with going concern doubts, executive compensation can sometimes be a point of contention for investors. This section reveals a lot about who is doing business with whom in the company. They conduct significant business with Energreen Nutrition Australia Pty Limited. In 2025, they bought over 14 million Australian dollars worth of seed from them. They also sold them nearly 762,000 Australian dollars of oils and over 5.8 million Australian dollars of meals. Energreen Nutrition Australia Pty Limited is controlled by Gary Seaton, their CEO, making this a significant related party transaction. They have substantial loans to and from related parties. The company owes over 6.5 million Australian dollars in related party loans payable, with a large chunk owed to Energreen Nutrition Australia Pty Limited. They also have trade payables due to related parties. With a significant amount owed to Energreen Nutrition Australia Pty Limited, these deep financial ties with related entities, particularly when the company is facing going concern issues, can sometimes raise questions about conflicts of interest and how resources are being allocated. This part details the actual shares and warrants the company has. They have ordinary shares, which represent ownership in the company. Holders of these shares get 1 vote for each share. Then there are the warrants. These give holders the right to buy ordinary shares at a specific price, $11.5 in this case, before they expire. The company can also call these warrants for redemption, which can be a bit of a double-edged sword for warrant holders. Here is who is selling shares. The list includes names like Guoxiang Cao, Kevin Chen, and Bob AI. These are individuals who are selling shares they received, likely as part of that business combination we talked about earlier. The company itself isn't selling shares here. It is these existing shareholders looking to cash out some of their investment. This section explains how those selling shareholders can sell their shares. They can sell them through brokers directly to buyers or in other ways. The company is essentially acting as a facilitator for these sales, but they don't receive any of the money from these transactions. For investors who are not US residents, this highlights the material US federal income tax consequences. It lays out how dividends and gains from selling shares might be taxed. Basically, dividends paid to foreign investors are usually taxed at 30%, unless a tax treaty says otherwise. Gains from selling shares are generally not taxed unless the company is considered a United States real property holding corporation, which they believe they are not. They also touch on complex rules like FACA and PFEC, which are important for foreign investors to understand, though they aim to show they don't expect to be a PFEC or passive foreign investment company, which can bring unfavorable tax treatments to us investors. For those interested in the company's home turf, the Cayman Islands tax considerations are pretty straightforward. They generally have no income tax, corporation tax, or capital gains tax. So, from a Cayman Islands tax perspective, it is quite favorable. This is the auditor's opinion. BDO Audit Pty Limited says that the financial statements present fairly in all material respects, the company's financial position, results, and cash flows. However, they also echoed the substantial doubt about the company's ability to continue as a going concern. This is a critical qualification from the auditors, signaling that their opinion is contingent on the company's ability to secure necessary funding and overcome its financial challenges. Looking at the balance sheet again confirms the picture. As of the 30th of June 2025, they have more liabilities than assets, but a significant positive shift in equity compared to the prior year, showing the impact of that debt restructuring and share conversions, probably from the business combination. The income statement shows that while revenues are growing, the cost of sales is growing even faster, squeezing their gross profit. The significant recapitalization expense in 2024 also dwarfs the operational results, highlighting the impact of going public. But the key takeaway here is the consistent loss for the year in 2025. even though it is smaller than the previous year. This statement shows how the equity portion of the company has changed. We see a large increase in share premium in 2024, likely from the business combination and related share issuances. Their retained earnings are deeply in the negative, showing accumulated losses over the years. The non-controlling interest also shows up, representing stakes in subsidiaries not owned by the main company. The notes are where the real details are. They explain that the business combination was accounted for as a recapitalization, meaning the SPAC is treated as the acquirer for accounting purposes. This is a complex accounting treatment used when a private company effectively buys a public shell company to go public. Note 2b. Concerning that substantial doubt regarding going concern is a must-read for anyone considering this company. They detail their reliance on bank loans, related party funding, and the potential for an equity line of credit, all of which are crucial for their survival. The financial details show a company that has grown revenue, particularly in retail, but is struggling with rising costs and debt expenses. The fact that they're still reporting losses and facing substantial doubt about their ability to continue as a going concern is a very serious warning sign. While the improved equity position is a step in the right direction, it seems largely driven by financial restructuring rather than a core improvement in operational profitability. So, what is the story here? Australian Oilseeds Holdings Limited is trying to carve out a niche in the sustainable and healthy food market. They've successfully navigated the complex process of becoming a public company through a SPAC merger. However, the financial picture is still quite precarious. Revenue is growing, especially in retail, which is promising, but the higher cost of goods sold and increased finance expenses are eating into their profits, leading to continued losses. The auditor's grim assessment about their ability to continue as a going concern is the most significant takeaway. It means the company's future is far from certain and hinges heavily on their ability to secure significant new funding. The reliance on related party loans and transactions also adds a layer of complexity and potential risk. Looking ahead, their strategy of expanding into retail and focusing on sustainable, chemical-free products is a solid market trend. If they can manage their costs better, secure that necessary funding without overly diluting existing shareholders, and continue to grow that retail segment, they might just pull through. But as it stands, this is a high-risk, high-reward situation. The risks are substantial, primarily stemming from their financial instability and operational costs. The opportunity lies in capturing a growing market for sustainable products, but the path there is fraught with uncertainty. That is our deep dive into Australian Oilseeds Holdings Limited's latest filing. What do you think of their financials and their strategy? Are they a diamond in the rough or a company facing an uphill battle? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe to Corporate Decoder for more in-depth analyses of the corporate world. And don't forget to join our Discord community for more discussions and insights. The link is in the description below. Thanks for watching, and we'll see you in the next one.